Hello friends, in today's session we are going to discuss the case of Commissioner of Income Tax versus Satlej Cotton Mill Supply Agencies Limited 1975 handed ITR 706711 SC. This case pertains to income tax assessment, where the plaintiff was directed to refund the tax imposed on the dividend received by the defendant Satlej Cotton Mills Supply Agency operating under the Birla Group, purchased share of Gwalior Rayon Mills and later sold them for a profit. The income tax officer considered this profit as business income and imposed tax on it. The appellate tribunal upheld this classification as business income, but the High Court ruled it as a capital receipt, exempting it from taxation. The Supreme Court overturned the High Court's decision and upheld the tribunal's ruling. The court stated that if an asset is bought and sold with a business perspective, the profit earned from it is taxable income. However, if the transaction was not carried out with a business objective, it would be considered a capital receipt. The nature of any transaction must be determined based on its context and purpose. Now let us study this case in details. Answer: Commissioner of Income Tax Appellant versus Satlej Cotton Mills Supply Agency Ltd.Respondent. Reference 1975 100 ITR 706 and 711 SC. Subject: this case pertains to income tax assessment, wherein the plaintiff was directed to refund the tax imposed on the dividends. Facts of the case. The facts of the case are as follows. First, Satlej Cotton Mills Supply Agency was a public company operating under the Birla Group. It applied to purchase some shares of Gwalior Rayon Mills, which was also under the Birla Group. This company was established on August 25, 1947 with a capital of Rs 5 lakhs, divided into 50,000 ordinary shares of Rs 10 each. Second, on December 31st, 1951, the Rayon Company issued new shares worth Rs 1.2 crores. The assessed company had already purchased 1,000 ordinary shares and later applied to buy 3.5 lakh new shares, for which it paid Rs 8.8 lakhs. Third one, in February, the company paid Rs 2.61 crores and passed a resolution to purchase share on the same day. Later, the SSE sold 1.58 lakh shares, earning a profit of Rs 2.13 lakhs. Fourth one, the income tax officer for the assessment year 1956 to 57 included the profit from the sale of shares in the total income, considering it as business income subject to taxation. Decision of the Income Tax Appellate Tribunal. The Income Tax Appellate Tribunal held that the profit was earned from a business transaction and should be taxed as income. The tribunal based its decision on the following grounds. First, the company's memorandum permitted the purchase of new shares. Second, between 1951 and 53, there had been transactions of buying and selling shares. Third, the income tax department had partially accepted the loss incurred in share transaction in 1951 to 52. Fourth, In 1951-52, a loss claim of rupees 6.30 lakhs in another company's share transaction was not accepted by the income tax department due to a lack of evidence. Fifth, the profit of rupees 2.13 lakhs was shown in the income statement. Sixth, the Gwalior Rayon Company had not declared any dividends between 1947 and 1956. Seventh, interest was paid on the borrowed funds used for purchasing shares. Eighth, shares were not placed for loan payment. High Court decision. The High Court refused to consider this transaction as a trading activity. The court observed that the company's formation did not include share trading as a business activity. The profit of rupees 2.13 lakhs was considered capital income rather than business income. There was no evidence that share was purchased using borrowed funds. The key issue in this case was whether the income from the sale of shares should be classified as business income or capital gain. If a property is bought and sold with a business intent, the profit is considered income and is taxable. If it is not done for business purposes, it is regarded as capital income. In G.V. Naidu and Company vs. CIT 1959 ITR 594, the Supreme Court ruled that if such a transaction occurs only once and result in actual business profit, it should be added to the trader's income. However, the mere buying and selling of shares cannot be considered regular business. Determining whether such a transaction is a business activity depends on the case's circumstances. If something is purchased with the intention of selling, it does not necessarily means it was done for business purpose. If capital is invested in purchasing something and later sold, its nature remains capital. Supreme Court's decision. The Supreme Court overturned the High Court decision and upheld the tribunal's ruling. The tribunal had thoroughly considered the presented evidence. The assessee had purchased shares using funds obtained from other sources. However, there was also evidence that the assessee's liabilities exceeded its assets. The Supreme Court accepted the fact that the assessee managed investment fund in a business-like manner. Supreme Court's judgment. The Supreme Court stated that the assessee never claimed that the shares were purchased for its sister company. Therefore, the High Court's judgment was incorrect. In such cases, the High Court cannot re-evaluate facts but can only provide guidance. The assessee company aimed to make a profit by purchasing shares rather than raising funds for its sister company. The Supreme Court found the tribunal decision appropriate and accepted the appeal. Legal principles established or propounded. The following legal principles were established. First, profit earned from selling an asset is considered income and is subject to taxation. Second, a company can only engage in trading if its memorandum permits it. Third, business profits are added to income, but occasional share trading does not necessarily constitute regular business. Fourth, if an asset is purchased as a capital investment and later sold, it is treated as a capital receipt and its nature remains capital. Please watch full video, share and subscribe my channel. Thank you.